Something big just broke in the silver market, and it's happening fast. We're talking about more than 30% wiped out in days. Spot silver opened this Monday around $81 to $82 an ounce after touching 121 just last week. That's not a typo. That's a collapse. And here's the part most headlines are missing. This wasn't just panic selling. The real trigger hit behind the scenes when CME Group raised silver margin requirements by roughly 36%, right as global markets reopened. Both futures desks and clearing brokers confirmed it over the weekend. Stay with me, because if you understand how this works, you'll spot it next time before the crowd does. Before I explain what caused this specific move, let me teach you something most people don't really understand about leverage markets. When you trade with margin, you're basically renting exposure. You're not paying full price. You're posting collateral. Now imagine your landlord suddenly doubles the rent overnight. Even if you love the apartment, you might still be forced to move. That's how margin hikes work. They don't care about fundamentals. They don't care about long-term conviction. They force action. And when enough people are forced to act at the same time, price stops reflecting opinion and starts reflecting mechanics. Think about it like this. In a normal market, price moves because buyers and sellers are debating value. One side thinks it's worth more, the other thinks it's worth less, and they meet somewhere in the middle. That's organic price discovery. But when margin requirements spike, the conversation changes completely. It's not about what silver is worth anymore. It's about who can afford to stay in the trade. And that shift, that's the lens you need right now. Here's what I mean. Let's say you're holding a position that was perfectly comfortable yesterday. Your account balance was fine. Your thesis was intact. You were willing to ride out some volatility. Then the exchange steps in and says, starting immediately, you need 36% more cash sitting in your account just to hold what you already own. What happens? Well, if you've got the extra capital lying around, maybe nothing. But most traders don't. Most traders are using their available margin pretty efficiently. So when the requirement jumps, they've got two choices: add more cash fast or reduce the position. And when the hike happens on a weekend and markets reopen Monday morning in Asia, there's no time to think it through. There's just action. Now, you might be wondering, why does the exchange even do this? And the answer is actually pretty straightforward. Exchanges manage risk for the entire system. When volatility expands and price swings get bigger, the risk of default increases. So they raise margin requirements to protect themselves and the clearinghouse from potential losses if a bunch of traders blow up at the same time. It's a defensive move. It's mechanical. But here's the irony. The thing they do to reduce systemic risk often creates the exact kind of forced selling that accelerates the move they're trying to contain. It's like pulling the emergency brake on a speeding train. Yeah, you might stop the train eventually, but everyone inside is getting thrown around first. If this is making sense, drop a comment below and let me know where you're watching this from. I want to know if you saw this coming or if it caught you off guard like it did most of the market. Now let's get into the mechanics of what actually happened under the hood. I'm going to break down the sequence the way traders see it, step by step, because understanding this process is how you'll recognize it next time in real time. First, silver spikes hard into last week, pulling in leveraged momentum players chasing upside. And I mean hard. We went from the mid-90s to 121 in a matter of days. That kind of move attracts a very specific type of trader, the fast money crowd. The people using maximum leverage to capture maximum return in minimum time. They're not patient. They're not long-term holders. They're there for the ride, and they're riding it with borrowed money. Second, volatility expands, which already strains margin balances. As price moves faster and swings get wider, your margin requirements start creeping up even before the exchange makes an official announcement. If you're sitting at 90% margin utilization, when the market's calm, you might hit 95 or even 100% just from volatility expanding. You're already on thin ice before anyone changes the rules. Then the exchange steps in. CME Group announces over the weekend that starting immediately when markets reopen, you need about 36% more collateral to hold the same position. Let that sink in for a second. If you were holding 100 contracts on Friday, you now need enough cash in your account to cover 136 contracts worth of margin just to keep what you've got. You didn't add to your position. The position didn't change. The requirement changed. So when markets reopen in Asia on Monday morning, accounts get margin calls. And here's what's wild about this. Those calls don't ask if you're bullish. They don't care if you think silver's going to 200. They don't even ask if you've got the cash coming in a few days. They just say, pay up right now, or we're liquidating your position for you. And if you can't meet the call, the broker doesn't wait. They sell. They have to. It's in the contract. So selling hits thin liquidity. And this is critical. Asian hours and early European trading don't have the same depth as New York hours. The order book is thinner, so when forced selling comes in size, there aren't enough buyers at current prices to absorb it smoothly. Price drops fast. And that price drop? It triggers more margin calls, because now accounts that were borderline but okay a few minutes ago are suddenly underwater, so they get liquidated too, and their selling pushes price even lower. That's the cascade. Now here's where it gets even more layered. As price breaks key technical levels, risk models flip from hold to reduce. You've got algorithmic systems, volatility targeting funds, and commodity trading advisors all running similar risk management protocols. When price breaks below certain levels, or when volatility spikes above certain thresholds, these systems automatically cut exposure. They're not making a judgment call, they're following preset rules, and all those rules say the same thing at the same time: sell. Meanwhile, short-term traders who were long and hoping for a continuation higher see the breakdown and bail. They're watching their screens, seeing 85 break, then 83, then 80, and they're thinking, this isn't a dip, this is a reversal. So they hit the exit. That's your confirmation layer. You've got forced liquidation from margin calls, systematic selling from risk models, and discretionary exits from fast money traders, all converging in the same direction at the same moment. And the convergence is what matters most. Any one of these forces alone might cause a pullback. All of them together at the same time in thin liquidity, that's how you get a 30% drawdown in days. You've got forced liquidation lining up with technical breakdowns at the exact same time. But here's the part that should make you nervous if you're trying to bottom pick right now. This kind of selling doesn't end cleanly. It doesn't stop just because price looks cheap or because the chart's oversold. It exhausts itself only when the last weak hand is gone. When everyone who was forced to sell has already sold. When everyone who wanted to sell has already sold. And you don't know when that point is until after it's passed. That's the danger of trying to catch this knife on the way down. Now, you've probably also heard the noise swirling around this move. Claims that the crash was engineered. People pointing at JP Chase positioning or disruptions at the London Metal Exchange and HSBC, arguing the timing was just a little too convenient and it hurt leveraged retail traders right when they were most exposed. Look, I get it. Those stories get attention because they feel personal. They give you someone to blame. They turn a market move into a narrative with heroes and villains. Let me be honest with you. I'm not here to tell you those theories are impossible. Markets are complex. Incentives exist. Big players have more information and better tools than retail traders do. That's reality. But whether you believe those stories or not, here's what matters. The price action itself doesn't require a villain. The mechanism alone is enough to do the damage. You had a leveraged spike, a margin hike, thin liquidity, and cascade selling. That's sufficient to explain what happened. You don't need a conspiracy when you've got mechanics. And focusing on what you can prove and what you can control is way more useful than focusing on what makes a good headline. You can't control exchange policy. You can't control whether some bank was positioned short and knew the hike was coming. You can't control any of that. What you can control is how you respond. And that response should be based on the structure of the market, not the story you're telling yourself about who's pulling the strings. This is also not the first time we've seen this exact movie. Zoom out and the pattern jumps off the screen. Let me walk you through a couple of examples so you can see how consistent this setup is. In 2011, silver crashed hard after margin hikes. The CME raised margin requirements 5 times in 8 days as silver ran from $30 to nearly $50. And what happened? The move reversed violently. Silver collapsed back into the 30s within weeks. But here's the key detail most people forget. It bounced early. There was a sharp rebound that looked convincing. People called the bottom. They said the worst was over, and then it retested lower before finally stabilizing. The early bounce was a trap. The durable low came later, after the volatility compressed, and the forced sellers were completely flushed out. Now jump to March of 2020. Different asset, same mechanics. When COVID hit and everything sold off together, you had forced liquidation across the board. Gold, silver, equities, credit, everything. Margin calls everywhere. Volatility spiking. Liquidity drying up. And what happened to silver specifically? It dropped from $18 to $12 in about 2 weeks. Massive sell-off. Then it bounced hard and fast back to 14, 15. People thought that was the bottom. It wasn't. It chopped around, retested lower, and only then did it put in a base that held. Same pattern. Sharp decline, early bounce that fails, then a retest before stabilizing. Every time this has happened, and I mean every single time, early bounces looked convincing until they didn't. The common thread across all these episodes isn't the price level. It's not the specific catalyst. It's volatility compression. Durable bottoms formed only after selling pressure eased into the US close, and volatility stopped expanding. When you see volatility peak and then grind lower over days, when you see selling that used to gap price lower start getting absorbed without new lows, that's when structure starts to heal. Not before. So when I look at where we are right now, I see the same setup forming again. Big spike, margin hike, forced liquidation, early bounce potential, and that pattern tells me to be patient. It tells me not to assume the first bounce is the real bottom. It tells me to wait for confirmation that the structure is actually healing, not just catching a short covering rally inside a downtrend. Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this snap back hard from here? Absolutely. Short covering rallies can be violent, especially after a 30% drawdown. If shorts get squeezed or if there's any positive catalyst that shifts sentiment fast, you could see silver rip back into the 90s or even higher in a matter of days. That's possible. Could the fundamentals still support higher silver prices long term? I think so. Industrial demand for silver didn't vanish overnight. Solar panel production is still growing. Electric vehicle adoption is still expanding. Electronics manufacturing didn't stop. The supply deficit story that people were talking about at 120 is still intact at 80. The physical market dynamics haven't changed just because the futures market had a liquidation event. Could this be manipulation like some people are claiming? Maybe. I'm not here to dismiss those concerns outright. But here's the thing. It doesn't actually matter for your trading and risk management whether this was orchestrated or organic. The mechanics are what matter. Whether someone planned this or it just happened because of how leveraged markets work under stress, the outcome is the same. Price went down hard. Positions got stopped out. Accounts got blown up. You can debate motive all you want. Focus on what you can control. And what you can control is this: your position size, your risk management, your timing, your emotional discipline. Those are the variables you own. You can't change exchange policy. You can't stop forced sellers. But you can decide how much you're willing to lose on a trade. You can decide where your stop is and actually honor it. You can decide to wait for confirmation instead of guessing where the bottom is. Here's what manipulation claims and heroic bottom calls do. They distract you from managing risk in real time. They make you think you're smarter than the market because you see through the conspiracy. And that's dangerous, because while you're focused on being right about the story, the market's focused on cleaning out weak hands. And if you're undercapitalized or overleveraged, you're a weak hand regardless of how smart your thesis is. There are probably 3 types of people watching this right now. And I want to speak to each of you directly because your situation and your next move are different depending on where you're starting from. First, you might already be long and hurting. Maybe you bought silver in the hundreds thinking it was going to 150. Maybe you're sitting on a position that's down 20, 30, 40%. If that's you, I need you to hear this. Your job right now isn't to be right. It's to survive. Ask yourself honestly, can you hold through another push down into 70 to 75 without blowing up your account? If the answer is no, you need to reduce risk now. Not later. Not after it bounces. Now. Because if you can't survive the next leg down, you won't be around to benefit from the eventual recovery. And there's no shame in cutting a losing position to preserve capital. Preservation is step 1. Opportunity is step 2. You can't get to step 2 if you don't survive step 1. Second, you might be flat and feeling like you missed the move. Maybe you were watching silver run and you didn't pull the trigger. Now it's collapsed and you're thinking about jumping in because it's cheap. And that fear of missing out is real. I get it, but here's what I'd tell you. Let the market prove stability before you step in. You don't get paid for being early. You get paid for being right. There's a big difference. Wait for signs that the selling pressure is exhausting. Wait for volatility to compress. Wait for price to hold a level on a retest. Those are your confirmation signals. And yeah, you might miss the absolute bottom. That's fine. Catching the bottom is ego. Catching the trend is profit. Third, you might be short or looking to trade volatility here. Maybe you're thinking about fading the next bounce or playing options around these swings. If that's you, respect the speed of this market right now. Forced moves cut both ways. Just like forced selling can push price down faster than fundamentals would suggest, forced covering can rip it back up just as fast. Sharp rallies happen inside downtrends all the time. So if you're playing the short side or trading spreads or vol, make sure you're managing your risk on both directions. Don't assume down is the only way this goes from here. For all of you, regardless of where you're positioned, the universal rule is this: confirmation beats prediction every single time. You can have the best thesis in the world. You can be right about the long-term direction. But if you're early and the market moves against you hard enough to stop you out, your thesis doesn't matter. You're out of the trade. So wait for the market to show you it's ready to move in your direction before you commit size. Here's what I want you to answer in the comments. Which of those 3 categories are you in right now? Are you long and managing risk? Are you flat and waiting for confirmation? Or are you looking to trade the volatility? Let me know where you stand because I'm genuinely curious how this move is affecting the community watching this. So here's where I stand personally. I'm not panicking, and I'm not calling a bottom either. I'm watching, I'm observing, I'm letting the market tell me what it wants to do instead of telling it what I want it to do. And that's a subtle but critical distinction. Let me tell you what I'm personally watching. First, I'm watching that 80 to 82 zone as immediate support. That's where we opened Monday morning after the weekend margin hike announcement. If that level holds and we start building a base there, consolidating, absorbing selling without making new lows, that's a positive sign. It doesn't mean we're out of the woods, but it means the initial flush might be stabilizing. If we break below 80 convincingly, then I'm watching the 70 to 75 area as the next major zone. Second, I'm watching whether we flush deeper into that 70 to 75 washout area and how fast we rebound if we do. If we spike down there and immediately snap back, that could be your capitulation low. That could be the final flush that clears out the last weak hands. But if we grind down there slowly and chop around, that's different. That's more distribution. That's more selling that needs to get absorbed. The speed and character of the move matters just as much as the price level. Third, and this is the most important one, I'm watching whether volatility and selling pressure ease into the US close over the next several sessions. This is the pattern from every historical precedent I showed you earlier. The real bottoms formed when volatility peaked and started compressing. When selling that used to gap price lower started getting absorbed. When the market stopped making new lows even though the news was still bad. That's when structure heals. So I'm watching for signs that we're transitioning from forced liquidation mode into stabilization mode, and that transition doesn't happen in one day. It's a process. Based on my analysis, this sell-off was mechanical, not emotional. It was structural, not fundamental. The fundamentals that supported higher silver prices a week ago are still in place today. Industrial demand is still strong. Supply is still constrained. Central banks are still holding rates lower than inflation in many regions. The dollar is still in a longer-term downtrend despite short-term bounces. Those macro factors didn't change because CME raised margin requirements. What changed is the structure of the futures market got over-leveraged, got hit with a margin hike, and unwound violently. That's a technical event, not a fundamental shift. But here's the reality. The structure still needs to heal. You can have the best fundamentals in the world, and if the technical structure is broken, price doesn't go up. It chops, it retests, it builds a base. And that process takes time, so I'm not rushing in here trying to be a hero. I'm waiting for the market to show me it's ready. If history rhymes and silver does put in a durable bottom after this volatility compresses and the weak hands are flushed, the move that follows could be significant. Because all that industrial demand is still there, all that supply deficit is still there, and everyone who got shaken out is going to be watching from the sidelines while price starts climbing again without them. That's how bottoms work. They form when nobody wants to buy, and then they rally when everyone wishes they had. But I want to be crystal clear about something. I'm not a financial advisor. This is not financial advice. Everything I've shared here is my perspective based on my analysis of historical patterns, current market structure, and the mechanics of leveraged markets. You need to do your own research. You need to make your own decisions based on your own risk tolerance, your own capital situation, and your own trading plan. Don't take anything I say as a recommendation to buy or sell anything. You own your decisions. That's critical. If you made it this far, you're the kind of person who thinks independently and wants to understand how markets actually work, not just what the headlines say. That mentality will serve you well. The people who survive and thrive in markets aren't the ones who predict every move perfectly. They're the ones who manage risk intelligently, adapt to changing conditions, and stay disciplined when everyone else is panicking or euphoric. If this breakdown helped you see the silver market differently, do me a favor. Share this with someone who's trying to make sense of what just happened. Hit that subscribe button if you want more content that cuts through the noise and focuses on structure and mechanics over hype. And stay ahead of the crowd by thinking critically, verifying the data, and making your own informed decisions. Stay sharp out there.